You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Thank you guys for tuning in today. We got a really good guest lined up for you today. But before we get into that, take a moment and go ahead and hit the subscribe button if you're watching this on YouTube or if you're listening to this on iTunes. And if you haven't left me a review yet, go ahead and leave a 5-star review if this shows add value to you. Hey, but that's the housekeeping. Let's get into today's guest. Anthony Pinto. Anthony Pinto is the owner of Pinto Capital Investments. They specialize in commercial real estate and apartment buildings. Specifically, they're seeking out to acquire B and C class apartment building as value add acquisitions, and they work with experienced syndicators and partners. Anthony has continued to grow his portfolio. Most recently they acquired a 104 unit portfolio and building in Hampton Roads, Virginia, and they're also looking for opportunities in Charlotte and Raleigh, and they like the Kansas City market as well. Hey, how you doing today, man? Let's talk about what you got going on, Anthony.
Sure, man. Yeah, happy to have. Thanks for having me here. I appreciate it. Yeah, I'm doing well, man. Doing well. Enjoying life here in Japan and working on real estate, and life's great. Life's great.
Yeah, that's awesome, man. So, tell us a little bit about who you are, because obviously this is a real quick bio, but tell us who you are and how you got involved with real estate.
Sure. So, like I said, my name is Anthony Pinto. I am an active duty submarine officer in the Navy, currently stationed over in Japan and about an hour and a half south of Tokyo. Been here for about 6 months. I have another 2.5 years here. Been in the Navy for about 6 years, formerly in Norfolk area, which is in the Hampton Roads area. I was there for about 4 years. And then, before that was kind of all over the country doing school. So that is my W-2 identity, if you want to call it that.
Right.
And that's what I do when I'm not doing real estate. Now, onto real estate. I was on a submarine out of Norfolk, specifically at the shipyard, for about 3 years, from 2016 to end of 2018. And during that time, being in the shipyard was rough. Being underway is one thing, because, you never really get to talk to your family. You obviously can't go out and do whatever you want because you're underway on a ship. Right. Yeah. And so, but it's that same kind of work schedule and workload when you're in a shipyard as well. So I never, even though I was, 15 miles away from my wife, I never really got to see her because we were working late nights and early mornings and all that. So, it got to the point where, after a year of marriage, we were really like roommates. We never really saw each other. We were kind of strangers in the night. And so, I was ending the end of my shore tour in 2018, and I just realized, I couldn't do another 15 years in the Navy and retire like that. I just, I saw how miserable my bosses were, and that's a job I would have taken. And, they had their own families and I never got to see them. So long story short, I just didn't want to be that person. And so what I did was I started looking for alternative means to supplement my income, and started looking more into what I could do after the Navy. And one of the things I stumbled upon in summer of 2018 was real estate investing. And how I stumbled upon that was I found a military investor. His name is Stuart Grazier, a good friend. And he gave me some pointers on some books to read, some people to talk to in the Norfolk area. And so from summer until Thanksgiving time period, I was underway. And so during that time, I read a number of different books, the quintessential Rich Dad, Poor Dad, Set for Life by Scott Trench. And I fell in love with this idea of real estate investing, and specifically house hacking.
Yeah.
I don't know how many of your listeners know, but I have, as a military member, I had the ability to access this program called the VA loan. And it is essentially a 0% down owner-occupied loan to be able to purchase your first home as a veteran. And we have caps and stuff on it, but essentially you can get a house for free and maybe even gain some money on it. by using this VA loan. But one of the cool things about the VA loan is you can buy anything up to a quad. So single family home, triplex, duplex, whatever.
Right.
So that's what we did. I was like, I want to buy multifamily for the additional cash flow I can get, the house hacking aspect of not having to pay for my own mortgage. The less relative risk there is with having more units spread out, in terms of vacancy, the risk there.
Right.
And so, I got off of my ship literally the day before Thanksgiving, and I told my wife, hey, we're going to move from our 4-bedroom house and 2,000 square foot house in Virginia Beach to this, this 4-unit apartment building essentially in Portsmouth, Virginia, which was like not a nice area. And as you can imagine, that went well with the wife. And, we talked it over, and we just kind of realized that, hey, she's going to have a decision in it as well. So it took a little while to kind of turn her over to the dark side on real estate investing. Yeah. But, so that was Thanksgiving time period. A couple of weeks later, started going to meetups, and met a real estate agent who was a veteran herself. She was a real estate investor, and she had the mindset for how to look at these properties. So I started talking with her, and I was like, hey, this is my goal. I want to use my VA loan to buy a small multifamily. What do you got for me? And so we started looking at different properties, and I think you'll find this really depends on the area. But Hampton Roads has a lot of small multifamily, like duplexes, triplexes, quads, but not a lot on the market. And so, there was maybe, 5 quads that were on the market at that time, and all of them were super overpriced. And I was like, I can't make these numbers work. Right. But one of them I found was really overpriced, but it had been on the market for about a year, and no one had touched it because it's overpriced. So long story short, we ended up buying that property for much lower than we thought we were, and got a really good deal on that. Closed on that one in January of 2019. While we had that one under contract, I found a triplex that was about 10 minutes away from that property. And through a joint venture with a couple other Navy guys, I purchased that property in end of February. Yep. And just started working on them. Moved into the quad, started renovating the units, all of that. Yep. Come April time, I kind of realized I could spend my time finding these smaller multifamilies and eventually get to 100 units and have all this cash flow. Or I could just buy a 100-unit apartment building or more and just build up units that way, right? And get the cash flow and minimize the risk from vacancy even more, right? Yeah. And not only that, but I could do it by using other people's money as well through passive investors. And I fell in love with that idea. And so I started going to a lot of different conferences, doing different courses, meeting and networking a lot of different people. Yep. And in the summer of 2019, in July, I had a 34 unit under contract by myself in Kansas City. And it was not a great property. And fortunately I was able to break the contract on that one during the due diligence period, because there was way more involved than I was willing to pay for. Right. It was a expensive lesson, but it was my own money that I lost on it. Right. I didn't lose any investor money. So I call it a win, but I definitely learned a lot from that experience. Right. So fast forward to November, I started my podcast, the Lessons in Real Estate show, or at least started doing interviews for it. Yeah. And one of the people that I first interviewed, his name is Phil, and I had known him for better part of a year at that point. He was a local investor in the area that was buying apartment buildings, which exactly what I wanted to do. And so I had him on the show, and afterwards we just started talking about stuff. And he's like, hey, I got this deal. It's 104 units. I know that you got all of this networking going on, and I think you might be a great asset to bring in. How much money do you think you could raise? And I was like, well, I don't know. Maybe it depends on the type of offering. I have a lot of non-accredited military investor friends who want to get in on these types of deals, but the SEC restrictions on 506C offerings, it doesn't apply to most of them, and you got to go find the people who are offering those B offerings. So Long story short, he brought me in on that deal, and we closed in mid-March on that, and I raised about $800,000 for that deal.
Wow.
And now we bought the property. It's stabilized still. It's doing well. We're following the business plan, and everything's going all right. But through that one connection through the podcast, I was able to get in on a general partnership on a 104 unit deal that I otherwise wouldn't have been able to. And now we're business partners and working on even bigger things coming down here at the end of the year. So
well, let me just pause you there for a minute, man. You unloaded a lot of value there, man. I wanted to just kind of pick it apart a little bit. So you started off with you was a homeowner, and you had to convince your wife to sell the house and go buy a quad in a not so nice neighborhood, right?
Yep.
So that was the first victory. You got your wife to say yes, so you won that one, right?
Right.
And then you found some people that was like-minded, that wanted to invest in real estate, and you was able to do a joint venture. And I want you to just take a moment and explain to my listeners what a joint venture is, because there's some people that they want to do large multifamily, but then there's some that says, man, I just want to get a deal done. And a joint venture is a great way to do that. So just take a moment and just explain what a joint venture is.
Sure. So when you're talking large multifamily, most of the time people buy multifamily. I would say most of the time. I think it's fairly common to use a syndication, which is essentially a large number of people pulling resources together to buy property that any one of them wouldn't be able to buy. So, essentially pulling, let's just say, $2 or $3 million together for the down payment, closing costs, all of that to purchase an apartment building. And you may have, 60 people on the team, including general partners and limited partners. A joint venture is similar to that, but everyone is an active partner on the deal and has to sign as, a loan guarantor or a partner as an active partner for the LLC of which you're forming to buy that property. Yeah. So how I structured mine and why I make that distinction is because active partners have to have specific kind of roles and responsibilities within that LLC that could potentially be audited by the SEC. Right. Versus, a syndication, the limited partners are limited for a reason, right? They're limited in their liability. They're buying a security specifically from you. So there's certain stipulations that you have to have when you're bringing on limited partners versus a joint venture. So that's why I bring up that difference. But with this joint venture, I didn't have the money to buy this triplex, but I did have the deal, and I did have pretty much everything else ready to go. I had the lending contacts, I had the real estate agent, I had the inspector, I had all these things ready to go. And, I had trusted my underwriting skills. And so what I did is I put a deal package together, and, it included information about the property, what the rents were, what the rents could be, the property management company, like all of those kinds of details that you would typically see in a deal package, like an apartment building deal package. So I put that together, and I started networking as much as I can. I started going to like every single real estate investing, meeting or meetup in my area. Started networking hard on bigger pockets. Just started talking with a ton of different people. And so the first investor I found was a guy who I went to college with. He was a couple years behind me. And I found it through Bigger Pockets, and we just started talking. He's like, "Hey, I got this deal. Would you be interested in, coming in on it for a return?" And so that was my first joint venture guy, and he brought in $12,000 for that, and we need to have 48 total. Yep. So the next guy I found was a sub guy just like me, and he had more experience than me, and so I kind of wanted him to come onto the team to bring his small multifamily experience and obviously bring in his money. Right. So within about 2 weeks of having this property under contract, I had it fully raised for in terms of the down payment and stuff. So it's just the three of us. We signed the contract, and I think this is key with a joint venture, is everyone has to be on the same page on what you're going to be doing with that property and how the returns are going to break down. What happens if a partner wants to get out? What happens if it's pretty boilerplate stuff when you set up a joint venture. in that regard. But there's a lot of things that you kind of have to negotiate. So, for example, I have 35% of the main partner has 50% of the cash flow, but he only has 35% of the equity, right? Yeah. And we set that up so that he could get certain return every month off of his money, right?
Right.
So you know, those type of negotiations are what you need to have when you're talking with joint venture guys. But on the other hand, don't discredit the fact that you don't have money. What did I bring to the table? Well, I brought the fact that I signed the loan. Like my name is on the loan alone, right? So, and I'm personally guaranteeing it. So if the property defaults, you know, they can come after all my assets.
Right.
You know, I did all the heavy lifting on finding the property manager, getting the lending together for it, doing the inspections. You know, I literally did heavy lifting by installing some appliances. Yeah. So, you know, don't discredit not only the sweat equity that you can put in, but the fact that you're signing for things, you know, signing your name on things goes a long way. And you're able to negotiate a pretty good, you can negotiate a pretty good deal in a joint venture, right? It always doesn't have to be hey, you get 75% of the deal and I just kind of want to take 25%. It doesn't have to be like that, right? You get what you negotiate, long story short.
Right. So the biggest takeaway for everybody that's listening is, you know, number one, it's no just set in stone, hey, this is what a joint venture looks like. You know, it's whatever you negotiate. And another great thing that Anthony mentioned here was that he did all the heavy lifting. He did all the work on the front end of the deal. So at that point, man, he controlled the deal. And once you can control the deal, then you got a lot of flexibility on what you can do and who you partner with on your opportunity. So, you know, for those that say, man, I would love to invest in real estate, but I don't have the money, then just simply do what Anthony just did and you'll be on your way for sure. All right, man. So you did that. And then you said, I want to talk about the mindset of going from buying, you know, freaking duplexes, quads and triplexes to saying, all right, man, I just want to buy 100 freaking unit buildings. So let's talk about the mindset. You know, what were you thinking? Was there any limiting beliefs that you needed to overcome to get to that level?
Yeah, I would say that any new investors getting started, just you can learn as much as you can, read all the books, listen to podcasts and stuff. But at the end of the day, you're not going to have an apartment building by reading a book. You're going to have an apartment building by taking action. And I think that's what was my driving factor was just I needed to take action, right? I was very motivated to get a deal done. You know, I wanted to be financially free, and I thought that, you know, apartment buildings would be the best way to do that. And so I threw myself solely into it, kind of to my own detriment. You know, what I learned is that I'm glad that I started on small multifamily, because those mistakes are much cheaper when you're dealing with 3 units than when you're dealing with 30 or 300 units. So, for example, the triplex that we bought was supposedly supposed to be turnkey. You know, a flipper had bought it and was going to do a burr on it, but decided to sell it instead. And so we bought a property that was essentially brand new. You know, brand new appliances, you know, kitchen, carpet, all that stuff.
Yeah.
And so when we walked into it, you know, I didn't expect a lot to go wrong with the property because it, you know, essentially brand new. But there were some things that were just kind of like red flags and kind of spidey senses tingling with this property that I just ignored and was like, hey, I can take care of that myself, because that was pretty handy. So long story short, we ended up buying this property, and like a month later, it hit termite season, like springtime.
Yeah. And
lo and behold, we have extensive termite infestation underneath the house.
Wow.
And like a ton of, I ended up spending like $7,000 of my own money on not only termite damage repair, but also to treat the termites. Yeah. And what had happened was that whoever had previously done a termite treatment had covered up the spots with insulation. Yeah. And so my inspector didn't see any of that. Yeah. So that was one thing. We had a break-in about 2 weeks after we bought the property, and all the brand new appliances were stolen. Wow. All of the air conditioning systems were stolen. That was about $13,000 worth of damage. So all of these things started going wrong. And these are things that I could have anticipated if I had listened to, you know, my stomach and my gut when buying that property. And so I took those to heart when I was looking at this 34 unit. And when I went to go visit it, those same red flags were going off in my head when I started touring the property. And that's when I was like, I ended up spending, 20 grand worth of damages to repair all this stuff on this other property.
Right.
What's it going to be if that same type of thing happens on the 34 unit? Right. So it just wasn't worth it to me. So I broke away from that. But I guess the mindset is one, you got to take action, and two, don't let knowledge stop you from just go ahead and doing it, right? One of my friends likes to say yes and then figure it out later. Yeah. And I think that goes far in this business. And one of the other things I like to say is you got to have one of three things to get started in real estate. You got to either have time, money, or experience. Yep. As long as you have one of those things, you can fill them in with partners, right? Right. So in my case, I had time. So I had the ability to go travel to visit the property, talk with brokers, all of that. What I didn't have, and I was not prepared for this, is I didn't have the money. I thought I was going to syndicate, but I didn't know anything about syndicating.
Right.
I thought I was going to bring in experienced partners to help with that. I had no clue how to do any of that. So I literally got to like the last week of due diligence on this property, which I didn't even realize it was the last week, because I thought that in the contract that we had written in a certain provision that the due diligence period didn't start until we got all the documents. Yeah. Well, when they sent it back to me and I signed it, I didn't see that they took that out. Oh, so wow. I was literally like the last week of a 30-day due diligence, and I didn't even think we had started.
Yeah.
So I made so many stupid mistakes, right? Yeah. But I would have never have learned those mistakes if I didn't go through that process, right?
Right.
And I learned a lot through that experience.
Absolutely.
So I think the mindset, outside of just taking action, is you just don't let not knowing enough stop you from just getting started, right?
Yeah.
You would be surprised how quickly you can pick up things and how fate kind of hands you the tools you need when you just get the ball rolling and get moving in the right direction, Yeah.
Yeah, that's pretty awesome, man. So I want to take a moment to, get you to explain, how did you go from raising $48,000 to do that deal you did with your joint venture to jumping in a syndication and raising $800,000? That's a pretty jump in the equity raising what you're doing. So what happened there that made you feel like you can raise that much money?
Well, so I actually fell short of my goal. I told Phil that I was going to raise $1 million. So I guess in that regard you can say I failed, but. Yeah, no, I see your point. So, and I think the big thing was I had more experience, and I was constantly networking with people. And not only that, but I was able to share the experiences I had with my triplex, with the quads, the experience I had with going through and buying a quad or a small multifamily with a VA loan. It just attracted a lot of people to me. Right. Especially a lot of military investors who wanted to do the same thing but didn't necessarily have the time. Yeah. So through those different connections, people were like, hey, they found out that I was working on multifamily and syndications. And I just said, hey, if you're interested in this, we got, this going on. We had a 506B, so it was open to non-accredited investors. Yeah. We set a lower minimum than you normally would see. So before I needed that money, I dug my hole. I dug my well pretty deep. So what I did was, I put my name out there, first of all, that I was doing multifamily. I went to conferences. I put out stuff on social media that I was going to conferences. Like everywhere I looked, I was putting stuff out that I was getting involved with real estate.
Yeah.
And not only that, but I actually started a multifamily meetup right before I left Hampton Roads. Yeah. And so my name got associated with multifamily. And so when people, military investors mainly, I say military investors because that was the vast majority of the people who invested with me. Right. When they thought of multifamily, my name came to mind. So when I had a multifamily deal, and granted it was a really good deal, then I was able to reach out to those guys and say, hey, we got this deal. It's kind of exclusive because there's not a lot of deals that are 5 or 6 Bs that that you hear about at least, on purpose. And so I was like, hey, this is kind of an exclusive deal. It gave you a chance to learn because, a number of them were interested in syndications as well. Yeah. And so, I had, close to 1.6, 1.7, like in soft commits raised.
Yeah.
And by the time everything kind of shook out, it fell to around 800,000. And so I think that's a lesson learned to take to heart when you're raising capital is you're going to lose a significant amount of the people who say that they're going to invest with you.
Yeah.
Just because it's not the right deal for them, something happens in their life. They're really just tire kickers and they weren't really actually interested in investing with you. I mean, insert the excuse for what happens, but it turns out to be about 50 to 60% of the people actually invest with you in the end. So and I think that's key to understand, not only to under promise and over deliver when you are capital raising, but also to do the same thing when you are raising as a whole for a property, right? I mean, if you need $3 million to close and closing costs, due diligence, reserves, all that stuff, you need $3 million. You should probably raise 4 or 5, or oversubscribe for it at the very least, right? Because all that's going to shake out. People are going to walk away. Yeah. So that's kind of how everything broke down with how I was able to get to that point where I could raise that much money. And honestly, like, I surprised myself. I didn't think I was gonna be able to raise that much, honestly. Yeah. And it just, one person after another just started coming out of the woodworks, and people started referring each other to other people. And then, I would say I had like personally had 40 investors sign up with me, and probably about a quarter of those were people who I never knew before we started raising, because they came from referrals, or they came from, I know this guy knows this guy, and whatever. Yeah. So I think another thing to think about is you have to dig that well before you need it, right? Because at that point you can speak from a position of authority when you say, hey, I can raise $1 million. Versus, hey, I've never talked to a single investor in my life. I don't know how to raise any capital. I'm brand new to this, but I want to be a capital raiser. Those are completely different things, and it takes a lot to talk to investors. Like, it really does, right? It's more than just a simple conversation of, hey, I have this great deal, let's jump on, right? Because most of the time it's not about the deal. It's about the operators who are bringing you the deal. And their experience, their background, what they've done, the type of returns they've seen, they've shown their other investors. I mean, there's so much that goes into it, but it mainly involves betting the team that you're with. So I would say that how I was able to raise that much is I had a great team that I worked with who had all the wickets to close on, a deal of this size. And just put my name out there. Constantly.
So if you could think back on, you say you had about 40, that you personally, spoke with, out of those 40, what percentage of those would you say came from, bigger pockets or LinkedIn, or, if you could break that down?
Let's see. I think so. Bigger pockets, I've only ever had experience with that first investor with bigger pockets. I haven't been as active on bigger pockets since then. In terms of LinkedIn, I think I maybe had 2 investors from LinkedIn. The majority of them, the vast majority, were from local RIA meetups back in Norfolk. Probably 35 of them were from local meetups. So they were
meetups
I knew.
So meetups are really, really good place. I want the listeners to really capture that. Meetups are a really, really good place to go and raise capital. First off, build relationships, because people are only going to do business with people they know, like, and trust. So if nobody trusts you, if you look like somebody slimy or sleazy, then they're not going to give you their money. So number one, go to the events, build a relationship, and then number two, know what you're talking about, and even if you don't have a deal, have a sample deal packet of, hey, this is what a deal will look like when I do get ready to do one. So I appreciate you sharing that, man.
Yeah, absolutely.
Yeah. So let's take a moment to dig into the actual deal. What did you guys see? No, number one, how was it identified? And then number two, what was the value add play? What kind of debt? Let's unpeel this deal.
Sure. So this deal was a 104 unit in Chesapeake, Virginia, which is it is south of Norfolk, Virginia. If anyone knows where that is, probably
Yep.
not. But it was actually on market. It was a market to Millichap property, and I had seen it in September of 19 before I left, and I got it in my email. And actually, one of my other investor friends sent it to me. It's like, hey, this is in your neck of the woods. What do you think? And I wrote it off initially because the financials were just not there to make it a good deal. It was in a flood zone, which, kind of immediately was a red flag for me.
Yeah.
So I wrote it off completely. And then, my friend brought it to me again. It's like, hey, the financials have kind of turned around in the past 3 months. We're able to negotiate with the city to get rid of this flood zone thing, because it was actually only in a flood zone on one corner of one building out of the 13 buildings, but they had to have flood insurance for the whole property.
Wow.
And the fact that he was an experienced operator within that market really kind of sealed the deal for me. If I was just a person by myself trying to take down that deal, like, it would not have gone well. So, the deal was on market, like I said, and he had already negotiated pretty much getting into due diligence by the time he brought me in. And so the deal was a little less than $10 million. And we had to raise 2.8 for it, including closing costs, reserves, down payment, all of that.
Yeah.
And so when we were looking at this deal, there was a ton of things that we could do with it. There's a lot of units that were way below market rent. There were a lot of units that needed renovations done. There's the ability to enact the RUBS as well. You ratio utility bill back system.
Yep.
We had some different options to raise income. So when we were running the numbers, even conservatively, we were able to show a 12% cash and cash return, and annual cash and cash return.
Yep.
Which was a pretty good deal. Not only that, but we were able to refinance at the 3-year point because we were using a bridge loan, and our business plan had us actually finishing at 2-year point.
Yep.
So the fact that we could get at least half of the investors' money back at that refinance, and then still keep equity in the deal, and still get 12% cash and cash return, like, that was a phenomenal deal. And so I think that's why we were able to bring in so many people on it, at least initially. Was because of how the kind of returns broke down on that. We were planning on doing a cost segregation analysis and all of that.
Yeah.
So overall it was a really good deal. Like, it was in a good neighborhood. It was right along the water. It has a boat launch, so people can go out and take their kayaks and whatever else straight onto the river. So it was a good starter deal, if you will.
Yeah.
Good first deal to get done.
Yeah.
Do you want me to get into like any more specifics on that, or
yeah?
Like how we broke it up
as far as the units, you say you guys got to rehab some units. What kind of rehab are you doing on the units?
Sure. So there was a mix of 1, 2, and 3 bedrooms, and some of them had an extra den as attached to them.
Yeah.
Which called a den. It was more of like a extra living room, if you will. And so some of those extra living rooms or dens, we were going to convert into either an extra bedroom or into an extra office or something, and advertise it like that.
Yeah.
We did renovations to the kitchen, updated the cabinets, put in new appliances, energy efficient appliances. If the flooring was bad, we replaced the flooring in the kitchen. Carpet throughout mostly carpet through the upstairs units because the building is old, so it creaks really badly.
Yeah.
We tried to muffle that as much as possible. LVP on the lower floors. We did some patchwork on some of the walls. Redid the bathrooms. New faucets and fixtures and hardware in there.
Yeah.
Put in ceiling fans. Exterior wise, we're putting in a couple dog parks. Updating the landscaping on the area. Installing some security cameras and like a traffic security gate when people come in. So a number of different things, but it roughly came out to be about $5,000 per unit.
Okay.
On average for all the units.
Gotcha. That's cool, man. So you was brought into the deal after it was already underwritten, but I want to take a moment and let's talk about underwriting because whether you're investing actively or passively, you need to have some kind of basic understanding of underwriting a deal. Would you agree with that?
Totally agree.
Yeah. So when underwriting a deal, man, what is the things that you look for that, makes it not a deal? Like I guess that's the biggest thing. What makes a deal not a deal when you're looking at underwriting?
Well, I think that you have to establish what are your baseline criteria, right? You got to know what you're shooting for, right? In terms of cash on cash return, IRR, number of units, price per unit. That's a common one lately. Yeah. All of these different metrics that you use to evaluate properties, right? It's going to be personal. Like I like to think of underwriting as unique as your fingerprint, right? Because everyone underwrites in a different manner, and everyone says conservative. Right. But that means different things to different people, right?
Yeah.
So I think, first of all, you need to establish what metrics you're evaluating these deals on, right? If you're looking at if your criteria is, 20 units to 50 units and all you're getting from brokers is 100 units and you're underwriting them, you're wasting your time. That's not what you want, right? And then vice versa, if everyone is sending you 4 units and you only, underwrite 100 units, right? So I think that will help clear a lot of clutter, because underwriting it's not an easy task. To truly underwrite a deal takes hours, right? Yeah. Even for an experienced person takes hours. Right. Because there's so much that goes into, outside of the financials that you get from the owner alone, you got to look at tax records. You got to look at other properties in the area. You got to do a rental analysis of the area. Yeah. You got to look at property management, what their thought process is. Can you even do utility bill back service? It may not be even legal in the area, right? So there's a lot of research you need to do. So in terms of underwriting a deal, what we look for is at least a 10% cash on cash return with a 15% IRR. We're mainly looking for, and I've kind of gone back and forth on this, is 50 units or higher, but we're willing to look at deals less than that, because I found that those smaller deals are often where you can get the most creative with your financing for it. Yeah. They're most often owned by individual owners rather than like a large syndication. Yeah. So you have a little more wiggle room with how you can negotiate, maybe doing seller finance or maybe doing a master lease option, something like that. And so those are kind of our big things: the value add, Class B, C properties in the Hampton Roads area. So from there, when we get a deal come in, at the minimum, the documents that you need are going to be a rent roll, as accurate as rent roll and most recent rent roll as you can, and then the P&L or T12. With those 2 documents, you should be able to at least get to an initial number on how to evaluate the property. Yeah. And so I'm sure your listeners know this, but to evaluate the property value, you got to take what the NOI is divided by the cap rate, and that'll give you what your property value is, right? Right. And so those 2 unknowns, NOI is something you could get from the P&L, right? And then the cap rate, again, you need to know your market, and that's part of the underwriting process. Is it can vary even by street by street what the cap rate is in the neighborhood, right? A really nice area is probably going to have a much lower cap rate than a really shitty area. Yeah. Pardon my French. So to evaluate the NOI, you can't just take it what face value what the owner is giving you, right? If they're showing you that they're making $1 million in revenue and they have a 30% expense ratio and they're making all of this cash, like that's not realistic, right? Yeah. They're probably not accounting for something. They're probably self-managing, right? So the key is to understand that you're buying the property at what it is right now. You're not buying the property after you've taken it over, you've renovated it 3 years later and basing it off what it's going to be worth then. Yeah. That's great if you can make extra returns off of that, right? Right. But you're buying it at a price that makes sense for you at the time, right? And that's something that I had trouble with when I was first getting started, because I was like, hey, this is a great deal. If I do this in the future, and it's going to cash flow so much. But, you're trying to underwrite conservatively, and I think the most conservative manner that you can underwrite is keeping the property as it is for the future. Right. If the property has to stay the way it is with the same NOI, with the same rent rolls, with the same rents and everything for the next 2 to 3 years, can you still make the returns that you need? And most of the time, that the answer is probably no, because properties are super overpriced.
Yeah.
But if you can get to a kind of a sweet spot between, hey, I can make pretty good returns on this, even conservatively, even saying, hey, you know, I may not be able to raise rents like now. I may not be able to raise rents for a couple of years just based off of COVID, just the way everything is.
Right.
So with keeping that in mind, you know, you just have to, I would treat the T12 as pro forma, and that it is lies, right?
Yeah.
You got to underwrite for what you want to underwrite. And most of the time, if a P&L is showing me, you know, 30, 35, 40%, you know, operating expense ratio, I automatically put it to 50. I don't underwrite for anything less than 50%. But on the other hand, if it's showing 70% expense ratio, man, that is a huge opportunity to bring that down to like an average of 50%, right? And every dollar that you make in lowering expenses, you make on NOI.
Yep.
And based on the cap rate, that directly translates to property value, which is which is the power of forced appreciation in commercial real estate, which I love, man.
Yeah.
So I hope that answers your question.
It definitely did, man. I know the listeners got, you know, some value out of that because you know, that's the part that a lot of people that talk about real estate, they kind of breeze over, but that's the most critical aspect of investing in commercial real estate is understanding how to underwrite and what's a deal and what's not a deal, you know. That's going to save you. So yeah, man, we're transitioning to the last segment of the show, man. It's the lightning round. I got about 5 questions for you. You ready for them?
Yep, let's hit them.
All right, man. What's the best advice you ever been given?
Like in real estate related or ever?
I mean, just ever.
I would say this is less advice and more of a quote. And that quote is, slow success builds character, fast success builds ego.
Like it. What's the best book you ever read?
Best book. In terms of real estate, I would say that it's the best ever apartment syndication book by Joe Fairless.
Yeah.
I mean, it's about as close as you get to a how-to on syndications as you're going to find.
Absolutely. What are some rituals that you're doing right now that's making you a better investor or person in general?
Yeah, so I've subscribed to the Miracle Morning, and I do that because it puts me in the place mentally and physically and really spiritually that I need to be to start my day off right. And whether I am going to my W-2 job or whether I'm spending all day doing real estate, it puts me in the framework that I need to be to start off my day, right? I do my exercise. It gives me like physical energy there, right? I read a little bit to get my mind flowing. I scribe, right? I talk about, you know, what is going on in my head right now, and what do I have to focus on that day. And one of my favorite parts is the silence part of it, because it gives me time to just be alone in my head. And when you're alone in your head, you start to think about what are your true priorities in life, right? You know, we're constantly running around, looking at our phones, checking emails, all these things, but we never take the time to just stay silent and just put everything aside and just let our mind wander. And you'll be surprised what you find out, not only about yourself, but about, you know, your life around you and what you build around you by just taking, you know, a few minutes to be silent and meditate in yourself. So I would say Miracle Morning.
Yeah, definitely. That's awesome. That's awesome. You know, what is one thing you're doing right now to help you improve your business?
One thing I'm doing is I have realized that, I don't know if you've ever read the book Think and Grow Rich by Napoleon Hill. But one of the first chapters he has in there is about masterminds. And he tells a short story about Henry Ford, how Henry Ford would, you know, got a subpoena and was getting sued and stuff. And he went up and was on the witness stand, and this lawyer was just drilling into him about how he didn't know all the specifics on his business. Yeah. And he stood up and said, you know, I may not know how to, you know, fix an engine, but I know how to find the person who can. Right. And he said that what he does is he had a board and he called it his mastermind, and all he had to do was push a button, and that expert came in and talked to him about that thing. And so I like to subscribe to that mindset, and is that like, I don't know everything. I mean, even if I've been doing this for 20 years, I still don't know everything, but there is someone who does, who can provide that sort of experience or that expertise or whatever I'm needing at that point. So I've started, instead of discrediting people because they don't directly have something to add to my life or business or whatever, I just started talking to them about what their interests are, what their life is. And I tend to learn a lot of life lessons just by doing that. Like, for example, 3 hours ago, I had an hour and a half long call with a friend of mine who was actually a passive investor on this 104 unit.
Yep.
And we just talked about building a business, right? Like the mechanics behind building a business, because, it's more than just finding properties and, finding lenders and getting properties under your belt. Like, if you're truly going to make this a business, there's a way more that goes into it, especially if you want to scale up. And I'm kind of getting to that point where we need to start scaling up. So that's what I do. I guess my answer would be is I constantly reach out to other people to help me grow and to help me expand my mindset. I'm never going to learn anything about myself I'm never going to learn anything by talking to myself. Right. So I like to talk to other people because that gives me the opportunity to question what my beliefs are and learn something new.
Yeah. That's an awesome answer, man. The network determines your net worth. So very true. All right. Last question for you, man. If you could give your younger self one tip in regards to investing, what would that be?
I would say is get started earlier. And not only that, but don't think that you can do it alone. Because I have found that when I failed, it's because I did something alone and didn't reach out to help. Yeah,
man, that's great advice, man. Appreciate you coming on the show today, Anthony. Sure. Tell my listeners, man, how can they get in touch with you?
Sure. So I'm on all the social medias, Facebook, Instagram, LinkedIn, so on. My company is Pinto Capital Investments. You can find us on our website. You can shoot me an email, Anthony@PintoCapitalInvestments.com. We also have a YouTube channel, Pinto Capital Investments, where we have a lot of educational content dealing with multifamily and commercial real estate. Videos on definitions, how to use retirement funds to invest, how to use other people's money to invest, why multifamily is one of the best investments you can find on the planet, things like that. We also have my podcast, which is the Lessons in Real Estate show, and you can find it on iTunes, Google Podcasts, all of those, Stitcher. But we bring on industry experts in multifamily and commercial real estate to talk about their lessons learned on their pathways to success. And one of the key things I like digging into is their failures, because it's great and inspirational to hear all these stories about successful people doing successful things, but I don't want to hear about that. I want to hear about the bad days that they have. I want to hear about the lessons learned that they have, right? Because if I can prove that person is human by the mistakes that they made, then I can prove to myself that I can do what they have done. So that's what I like to focus on the show. But to get away from what you're saying, you can reach me at any one of those methods. And specifically, if there are any military investors that that listen to your show that want to talk to me about how to get started in, house hacking, multifamily, syndications, want to learn how to passively invest, I'm happy to talk with them. Shoot me an email, Anthony@PintoCapitalInvestments.com.
Sounds good, man. Appreciate you coming on the show today.
Thanks for having me. It was a blast.
Absolutely.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.